Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Salem Abraham, founder of Abraham Trading Company, and it's great to have you with us. Salem, you've traded across asset classes for 30 plus years and have been pounding the table that investors, retail through institutional, are grossly overexposed to equities. Why did you come to that conclusion, and what's the consequence?
Yeah, it's great to be here with you, Jill. Thanks. I've been in the investment business a long time, and so you see this, it's been this slow creep, what I've seen over my career, of more and more equities. And it's gotten to a point where you just say, this is way too risky, I think. And I think it's more risky than people realize. And I just see more and more exposure in equities, less in fixed income. And I think at some point, it's going to bite people, and I think they don't fully understand the risk they're taking. You know, diversification is a bedrock principle of investing. It still matters, and beta is nice, but beta can bite, and big beta bites big.
Tell us more about the work you're doing with foundations and endowments and why you are urging caution with their current asset allocation models.
Well, sure, because I think the history of it, and looking back in the history of kind of portfolio construction and where we've been and where we are now is helpful. And if you look back in the 1970 to 85, we had you had a lot of people had 100% fixed income. In the 70s, you could make 7-8% in a 10-year treasury, and now we're at a tenth that. So people have migrated from that to then they went to 60-40. And back 30 years ago, 60-40 was a model. Now, after 08 and the low rates in bonds, now we've crept to, the benchmark is now 70-30. And then even now, if you look at the 30, no one has 30. Mm-hmm. You look at the big endowments, and they typically have 5 to 10%. And some of the things that are in that other part, these bond substitutes, they have beta in them. So, people say, well, we've got these 10 asset classes, but all of them have varying degrees of beta. And so I think, again, it's kind of like that frog in the pot of water. You keep turning it up and it doesn't seem like that much, but at some point you get to a spot, you say, wow, we have a lot of beta in these portfolios. And I think we've got to be careful. And if you look back, think of like 2008, we had a 50% drawdown. And but think of back in the Depression. So in September of 29, you had the Dow at 381. 2.5 years later, it was at 41. It was an 89% drop. And people say, well, yeah, that was a long time ago. It's like, yeah, kind of like pandemics. And so if you have 80% exposure in stocks and you drop 50%, you've lost 40% of your money. But the other dumb thing of this is, don't forget, we've dialed back the fixed income piece. And so, and that used to be the piece that is negatively correlated in big downturns. So that would have helped us. And so if you lose 40%, in your equity piece, and really your fixed income piece isn't helping you as much, then I think instead of losing, say, 25%, which is what most people lost, these big endowments lost in 2008, today I think we'd be losing 35%. And I think most people haven't really thought it through well enough. And I think they need to think it through better and really ask themselves, are you okay with losing 35% of your portfolio? I mean, it's going to take, you have to make 50% to get back even. I think that's a lot.
Right. And Salem, I'm going to throw this question in here because, of course, it's psychology as well. The market's done extraordinarily well for over a decade now, and there's this manic out there to beat your benchmarks. You're not getting any yield whatsoever from the fixed income market. So right. I think it's psychology as well, and this rush to performance that has right. also impacted management style. So tell us about your Fortress Fund and how it is built to dampen stock market losses and volatility.
Right. Well, the Fortress Fund, the basic concept is, diversification does matter. We're going to do the math with it. My team is a team of math people and data and quant people. And so we really, and then having been in the hedge fund space for over 3 decades, we understand alternatives well. So we've just tried to say, look, we're not going to have that exposure to equities. Our typical portfolio today is 45% equities, 20% fixed income, and 35% alternatives, including gold, some exposure to gold. And we just think it's a better balanced portfolio. And really, it's easy for me to say, hey, we ought to do this, and talk's cheap. But the Fortress Fund, if you look at the track record, we beat 70-30, and we've done so with a third less vol. And so it can be done. And I would encourage your viewers to look at their portfolio and think about it and say, hey, maybe there's a better way than just chasing stocks. And I know stocks are a great time, but in 1929, everybody had a great time up until the end. And so, there's a better way. We've proven it can be done in the fortress. I think, I've encouraged endowments and foundations, and I would encourage your viewers just to say, hey, what can I do to bring diversification back into my portfolio?
Salem, I know you take a long-term investing view, but in an election year and with so much else that's happened through 2020, should investors brace for more volatility?
Well, if you look at the VIX is double what it's been. I mean, and so I think certainly the market thinks there can be volatility. In normal times, there's always the known unknowns and the unknown unknowns. There's things that these lightning strikes out of nowhere can come to. I mean, a year ago, who would have thought we had a pandemic here on our hands? So I think the important thing is always be prepared. I would tell people, I don't know. I'm a professional investor. I don't always know what's coming. I don't think anyone does. It's like when you leave your house every day, it's like you don't think, well, is today a seatbelt wearing day? And you go, no, every day is a seatbelt wearing day. Or, and if you live in a house that's been built to withstand the storm, you don't fear the storm. And so whether it's today or tomorrow or 10 years from now, the storms will come. It's just, how did you build your house? And for those people that want very high exposure in equities, I'd say that's fine. It's a good ride, but I'd wear my seatbelt, cinch it down tight, and bring a barf bag, because some point or another you're going to need it. So.
All right, so let's wrap up with more of a near term look. The trading action we saw on Thursday, September 3rd, okay. Friday, September 4th. If you're catching this on the replay, we saw stocks sell off sharply without much of a fundamental explanation. There could have been an unwind trade in there, with the exception of valuation, right? So 2020, it's been a year where there are these extreme pops and drops, with the averages moving anywhere from 3 to 5% on the up and the downside. Should investors continue to brace for those kinds of moves on a more regular basis?
Yeah, no, I think when you've got this much uncertainty in the market, Jill, it's inevitable there's going to be movement and people are on edge, and it's just, that's the environment we're in right now. It happens every now and then, and we're in it now. So yes.
All right. Yeah, I'm sure a lot of people looking forward to getting to the end of 2020. Salem, it was great to have you with us. Thanks so much for joining me on Trade Talks.
You bet, Jill. Thanks for having me. See you.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.